Good afternoon, everyone, and thank you for being here today. My name is LaLomia, and I'll be your presenter. We're going to talk about what's likely to be one of your most important retirement decisions that you'll ever make. What should you do with your retirement money in the TSP, your 401k, your 403b, once you leave your job? A lot of people mistakenly think this is an easy choice, but that's rarely the case. Depending on your particular situation, you may have up to six different options to choose from. So today, we're going to talk about each of those six options so that you can make the best decision for you and your family. We'll also shed some light on common mistakes so you can avoid those. Before we do that, let me tell you a little bit about myself, my company. Again, my name is Kurt. I'll be teaching today's lesson. I'll review the slide deck we've put together for about 30 minutes, and then we'll get into some Q&A. You're going to put your questions in the chat. My company, Turning Point Financial, is what's known as a registered investment advisor. Our home office is located in Frederick, Maryland, and the SEC is our regulator. We're fiduciaries. We're independent. We're a team of 30, and we offer financial planning, investment management, tax services, insurance, and other services. I specialize with federal employees, and our firm knows your benefits well. So now that you know a little bit about me, let's talk about the 6 rollover options when you leave your job. Depending on your specific circumstances, you'll be able to do at least one of these options. While there are 6, there really are just 1 or 2 that most people do because they make the most sense. And we'll dive into why. The 6 options are as follows. Leave it in your TSP. Roll it over to a new employer plan if you're changing jobs. Roll it over to an IRA. Take a lump sum distribution. Convert your plan assets to a Roth IRA or make an in-plan Roth conversion. That one we're not going to spend too much time on because that's not yet available in TSP. In some cases, you might be able to combine some of these options on the list. For example, you might decide to convert some of your plan funds to a Roth IRA and roll the rest over to a traditional IRA. Others may want to roll over half their TSP and then keep the other half there. First option, the most straightforward of the possibilities, is to leave your retirement funds in the TSP. If you choose to do nothing, you're essentially choosing this option. Of course, there are a number of reasons why you might intentionally leave your money at your plan too. Most of you will have this option available. There are a few times when the plan will force you to take a distribution. It's usually for smaller amounts. I usually don't recommend this option because your life's going to be changing in a very big way. You're transitioning from the accumulation phase to the distribution phase. The TSP is wonderful for accumulation and it's easy. Distributions, they're not easy. And the TSP fails miserably with how they manage your distributions. The TSP is built for the masses, while an IRA can be tailored to your unique needs. We're going to explore that more in Q&A, I'm sure. If you're lucky enough to be retiring early, or if you've otherwise left your former employer in the year you turned 55 or later, you can take penalty-free distributions from the TSP. This is different than the general rule, which says you have to wait until you're 59 and a half to take penalty-free distributions. Once you're older than 59 and a half, this is no longer a concern. If creditor protection is a significant concern for you, that's another reason it may make sense to keep your money at the TSP. Certain plans offer creditor protection under the Employee Retirement Income Securities Act. That's a mouthful. Better known as ERISA. ERISA offers strong creditor protection and safeguards your assets from creditors. On the other hand, IRAs, and I know many of you have IRAs, they don't receive ERISA creditor protection, but they do under state law. Thankfully, most states provide retirement funds with creditor protection that's roughly the equivalent to what we have under ERISA. Not always the case. Every state's different. If this applies to you, you're going to want to look into it. Fees. You should always be aware of the fees that you're paying in your current plan, the TSP, and the difference, if any, of the fees you'll be paying if you move your retirement money somewhere else. If you've attended my events before, and I know many of you have, or if you're a current client, and I see a few of those on here today, you know that I'm upfront and transparent with my fees and how I get paid. You should be getting expert advice for the fees you pay, and that's why my clients hire me. Further, you're less likely to make a big mistake if you're working with a financial advisor. In my experience, the value of the advice our firm provides, it far exceeds the fees that our clients pay. Some savvy do-it-yourselfers that put the time in, they can go it alone, but that's very few people. Many do-it-yourselfers are so hung up on the fees, they may be saving nickels, but what's really happening is they're losing dimes and they don't even realize it. The costly mistakes that I see are usually more than the fees for professional advice. Common mistakes include folks that don't rebalance their portfolios, don't have the right asset allocation. They don't have a tax-efficient distribution strategy, and they get bad advice from inexperienced call center employees. What I'm trying to convey here is that if you're able to find the right financial advisor that's a good fit for your circumstances, what you pay them will be returned to you many times over. Let's move on. Of course, no solution is going to be perfect all the time, and just leaving your money with your old employer is no exception. There are any number of reasons this might make sense for you, some of which you can see here. Okay, so far we've talked about why it makes sense to keep your money in the TSP, but many people choose to move their TSP money elsewhere after they leave their job, either to another plan or more commonly to the IRA. Before we talk about why that could make sense for you, let's talk about how to move the money. In general, there are two ways that you can move the money from one retirement plan, your TSP, to another retirement account, the IRA, or your new employer plan. You can either move it indirectly, and that's known as a 60-day rollover, or you can move it right from your TSP to your new retirement account. That's called a direct rollover, and the direct rollover is generally the best way to move your money. Let's take a look at why. With the indirect rollover, you receive the distribution of your TSP and it's payable to you. Then you have 60 days from the time you receive that check to get it back into another retirement account. 60 days may sound like a long time. That will go by in what seems like the blink of an eye. Let's face it, life happens. People get distracted, sick, simply forget. And if that happens to you and you miss the 60-day deadline, that distribution, that check you receive from TSP, it's taxable. And depending on your age, it may be subject to an additional 10% penalty. Even if you're on top of things and complete your rollover within the 60-day window, there's another problem with the indirect rollover. When Congress created the plan distribution rules, they wanted to make sure people didn't take the money and run. So they created a special rule. And that special rule requires plans to withhold 20% of taxable distributions that are payable to you. For example, let's say you have $100,000 in your TSP. You request a distribution for the entire amount. TSP is going to send you a check for $80,000 and withhold $20,000 and send that to the IRS. If you take that 80,000 and roll it over timely within the 60 days, have you completed the full rollover? No. Even though you only received 80, 100 was actually distributed. If you want to complete the full rollover and avoid any taxes on your distribution, you have to both roll over the 80,000 and make up the 20,000 withheld from your other savings. And what if you don't have $20,000 just lying around? Well, that's just too bad. And just imagine if your distribution is larger, say 500,000. In that case, in order to complete a full rollover, you'd have to come up with a whopping $100,000 to make up the amount withheld for income tax. This is dangerous, to say the least, and I don't recommend it. As you can see, there's real problems with indirect rollovers. Thankfully, there's a better way, and that's the direct rollover. In the direct rollover, your plan money is sent right from the TSP to the new retirement account. Most importantly, no 60-day time limit, no mandatory 20% withholding. This is what most folks do and what I recommend whenever the rollover option is appropriate. Sometimes, though, and TSP does this, they won't send the money right to the new retirement account. They still have to allow for the direct rollover. This is done by providing you with a check that's payable to your new custodian. For example, the check might read SEI Private Trust Company. That's our custodian. That's the investment company that we work with, similar to a Schwab or a Fidelity. The check's payable SEI Private Trust Company for the benefit of Kurt LaLomia IRA. If the check is payable in this way, your distribution still qualifies as a direct rollover to get the favorable tax treatment. No 60 days, no mandatory withholding. That's true whether TSP sends the check to you or to me. There is an option with TSP distributions to have the check sent directly to the financial institution or the financial advisor. There's an extra step involved in the process, but we do it all the time. Now that we understand the different ways that you can move retirement money, let's go back to exploring your rollover options. If you go back to work for a new employer that offers a retirement plan, you might be able to roll that into your new plan. We all know TSP accepts rollovers from old plans. Just as they do, your new employer may do the same. Not all of them allow it. You're going to want to check the rules. The reasons to roll money into the new employer plan are generally the same as what we talked about before, leaving money in the old plan. Creditor protection, consolidation, that sort of stuff. In addition to the benefits we discussed before, there are a few other reasons you might roll your old plan funds into the new plan. One reason, if you need to take a loan from your retirement money, you can take a loan of up to $50,000 from your TSP, your 401k, your 403b. Can't do that from an IRA. That's known as a prohibited transaction, and that comes with some scary tax consequences. More practical reason to roll your money from the old plan to the new plan, that's consolidation. Many people, particularly as they get closer to retirement, they want to simplify their financial lives. Rolling money from your old plan to your new plan, that means one less account statement to keep track of, one less beneficiary form to keep track of, one less account to make sure the appropriate RMDs, required minimum distributions, have been taken, And one less login. I think you get the point. Once again, this strategy, not for everyone. Since this is a very similar option to our first, you'll notice many of the same potential disadvantages. Moving along. The third option, when you leave federal service and the option that's available to you is a rollover to an IRA. This is the preferred option for many when they leave their employer, federal service, for many reasons, and we're going to get into that. The most common reason people choose to roll over their TSP to an IRA, greater menu of investment choices. TSP only has 5 funds. They're good funds. While the investments offered by TSP, they may be sufficient for your needs through the accumulation phase. Many folks, they want and need to expand their investment options by rolling over to an IRA. This speaks to what I said earlier about the TSP being built for the masses versus rolling it over to an IRA that's customized for your family's needs. Once inside the IRA, there are very few restrictions on what you can invest in. There's really only 3 things you can't invest in an IRA: life insurance, collectibles, S-Corp stock. IRA gets tailored to your specific needs. That's the point there. Another common reason many retirees choose the IRA is to consolidate their retirement savings. A Department of Labor study reported that folks born between 1957 and 1964, on average, they held 11 different jobs between the ages of 18 and 46. Sure, it's unlikely you'll have 11 different employer retirement plans, but you certainly could have participated in a few of those. An IRA serves as a convenient collection point for these old plans, leaving you with fewer accounts to keep track of and watch over. And in my experience, old employer plans, they're never looked at. And that means your money's not being managed to your needs and goals for your retirement phase. IRAs often offer more attractive withdrawal options than the TSP. With an IRA, for instance, you can generally request a distribution whenever you want it. I tell my clients their money's never more than a phone call away. If you leave your money in the TSP or you roll it over to a new one, you're stuck with the plan rules. Your company might be flexible, but it might not be. Another big difference between company plans and IRAs on the withdrawal end is there's no mandatory 20% withholding on IRA distributions. With IRAs, you can choose the federal and state tax withholding amounts, or you can choose to not have anything withheld. You just got to settle up when you file your taxes. We do a lot of work with this with our clients, and that's another area where working with a financial advisor can be valuable. Another nice thing about IRAs is that if you have more than one of them, you can calculate your RMD, or required minimum distribution, for each account and take it from just one. So for instance, if you have one account that you really like or that's doing really well, you want to leave it alone. And maybe you have another account that's not doing well. You can take the RMD for both accounts from the IRA that's not doing so well. You can't do that at the TSP. In fact, you can't tell TSP, it's a down year in the stock market. I don't want to sell my C fund. Just take my distribution from the G fund. It doesn't work that way. TSP sells proportionally across all of your accounts to get you the money you need. That is not an efficient withdrawal strategy. Let's look at the examples on the screen. John has 3 IRAs, and his RMDs for the 3 accounts are 5,000, 3,000, 2,000, 10,000 total. John can take the 10,000 from any one of those or a combination of those, his choice. Jane, on the other hand, she has some old 401ks. Her RMD amounts are the same, 5, 3, and 2, 10,000 total. The difference is, in order for her to avoid penalties, Jane has to take 5,000 from that first account, 3,000 from the second, 2,000 from the third. She can't combine them. A lot of work, a lot of headache there. Rolling over the TSP to an IRA can also provide estate planning benefits, such as making it easier for your beneficiaries after you're gone by consolidating accounts. On the other hand, in some cases, rolling your money into an IRA can be beneficial for the opposite reason. Doing so may allow you to split your accounts into multiple accounts, each left to a different beneficiary. That may be helpful in situations like the ones you see here. Some plans may not accept certain beneficiaries, such as trusts. They may not allow you to use customized beneficiary forms or allow your beneficiaries to utilize certain strategies like disclaiming. Rolling your plan funds to an IRA that allows for these options, it resolves that issue. Also noteworthy, it's the value of working with a financial advisor for advice, guidance, peace of mind. This is an incredibly important concept, one that it's often not understood. As you can see here, there are a number of potential benefits to rolling over your money to an IRA. To review those, broad array of investment options, more flexible distribution options, RMD aggregation, estate planning flexibility, professional advice from working with an advisor. When it comes down to it, all of these things can really be summed up in one word, control. In general, an IRA simply gives you more control. But they're not perfect. And as you can see here, there could be some downsides to making this move. Folks, you can get a copy of these slides. Just shoot me an email. I'll have my contact information up at the end. Happy to share today's slides. We're going to move on. That's through the first 3. That was a little lengthy. The next 3 go pretty quick because they're less common. Our fourth option, taking money out of the plan. We call this cashing out your plan. In general, this is not a good idea. You'll have to add this distribution to your income. This is taking money out of your TSP and having it sent directly to you, payable to you. You're sticking it in the bank. You also lose the tax deferral on those funds. Remember, your money's growing inside of the TSP, and you don't have to pay taxes on interest, dividends, capital gains. Despite compelling reasons like these, an alarming number of people still cash out their TSP when they leave federal service. Now, I said that it's generally not a good idea to cash out your plan, but that's not always the case. In fact, if you're lucky enough to have the right set of circumstances, cashing out might make sense. And what you see here, this net unrealized appreciation, is a strategy that would apply to folks in the private sector, and maybe some of you have a spouse or a partner that work in the private sector. If they have a lot of company stock they've accumulated in their retirement plan, net unrealized appreciation is a strategy they need to know about, we should talk about, and they can utilize to have big tax savings. I'm not going to spend any time on this for you all because it's not appropriate to our large federal audience here today. But again, lump sum distribution, payable to you. There's rules around it. We're going to skip through a few of these slides. If you need help with this, you can email me, set up a meeting. and I'd be happy to take you through all there is to know about NUA and the benefits of it. Just bear with me. Okay. Time to move on and talk about our fifth option, Roth IRA conversion. While this is certainly not going to be the best option for everyone, it's an option everyone has, and it's one that everyone should consider. If you've been with me before, you know I'm big on the Roth contributions, Roth conversions. In a Roth IRA conversions, funds go directly from your TSP to a Roth IRA. And it's very important to understand this is a taxable event, meaning the amount you convert, it's added to your tax return for that year. While this is a strategy, it's not one I like or recommend. A better way to do it and still take advantage of Roth conversion opportunities is to roll your traditional funds in the TSP to a traditional IRA. No tax consequences there. Then each year, we're going to evaluate whether or not the Roth conversion makes sense. Our firm draws on the expertise of our tax department. We put together a multi-year tax strategy, and we may convert a little each year. Let's continue with the concept of moving money directly from the TSP to the Roth and tell you how that goes. For example, Jane has $100,000 in her TSP. She wants to convert that to a Roth. We'll talk about why in just a moment. If Jane moves forward with her Roth IRA conversion and converts the $100,000 TSP balance, she'll have to add $100,000, and she gets a tax form, a 1099-R, showing that her income for that year was increased by $100,000. Now, because this is a taxable event, obviously it's always best to discuss this option with your tax advisor and your financial advisor beforehand. Now, at some point, you've probably heard that you should never pay taxes before you have to. That's a very traditional way of thinking, and in many cases, it may hold true for you. There are a number of reasons why you might consider a Roth conversion. First and foremost is the potential for tax-free distributions from the Roth IRA in the future. If you're over 59 and a half and you've had any Roth IRA for more than 5 years, distributions from any of your Roth IRAs, they're going to be tax-free. If you're over 59 and a half and haven't had a Roth IRA for the 5-year holding period, there's a 5-year rule. Some of you are familiar with that. You can still take out any converted amount. If you're younger than 59 and a half, there's different rules. For instance, Jane is 60. She converts 100,000 from TSP to Roth. It grows to 300 by the time she's 70. If Jane wants to, she can take the distribution of the entire 300,000 tax-free, penalty-free. Beautiful thing. If Jane had needed the money when she was 63, we're still within that 5-year window, she could only take out the 100,000 that she converted without taxes and penalties. The potential tax-free nature of the Roth IRA, it may also provide you with additional benefits, such as a hedge against tax rates rising in the future. Most people believe that's going to happen. When it comes to your retirement, there are a lot of unknowns. What will the markets do? What will inflation be like? What will your tax rates be? And so on. The last one, taxes, that's a major concern for most retirees. And the Roth IRA conversion can help you manage that risk by paying taxes at today's known rates, which are at historical lows. If tax rates rise in the future, tax-free distributions from Roth IRAs will be even more valuable. Of course, if you think your tax rate will be lower in retirement, then that would be indication that maybe this strategy is not right for you. Also, since Roth IRA distributions in retirement are generally tax-free, they typically don't impact other things tied to your income. We talked about this at webinars last year, and we'll revisit it again this year. For instance, Roth IRA distributions are not included in the calculation that determines how much of your Social Security income is taxed. Same with Medicare Part B premiums. Distributions from your Roth IRA are invisible on your tax return, and they don't impact how Social Security is taxed, and they don't impact what your Medicare premium will be. Let's move on. Another big benefit of the Roth, and one that many retirees find attractive, is there's no minimum required distributions. So during your retirement, you can take as much or as little as you want, or none. Required minimum distributions, for those that may not know, that's the federal government telling you to take a certain amount of money out of your traditional accounts when you're age 73. That bumps up to age 75 at some future point. So if you're in the Roth, you don't have to take the money out. They can continue to grow and compound tax-free for your heirs. Roth IRAs are excellent for estate planning because your beneficiaries receive tax-free distributions. Here we go again. Like I've said before, this strategy, it's not for everyone. Here's a long list of potential limitations. Again, if you'd like a copy of the slides, shoot me an email. I'll have my contact information up in just a moment. Okay, the sixth option. Folks, I appreciate your patience. This one is going to go very quickly because it's brand new. I haven't seen it anywhere. I don't know anybody that's done this, but you can do a Roth conversion inside of employer retirement plans right now. Not in the TSP, but maybe some 401ks, 403bs. It's brand new. It's not available to most folks now. It's identical, well, nearly identical to the Roth IRA conversion we talked about earlier. But there's one big difference, and we're going to skip through this to get you there. Same type of tax implications. Here's the big difference. Retirement accounts sponsored by employers have required minimum distributions for the Roth portion, unlike IRAs. Strange, different, something to be aware of. I'm not sure why you do this. Hope that helps. Hope that makes sense. Again, this strategy, not for everyone, not applicable for federal employees because not available in TSP currently. As you probably realize by this point, the decision of what to do with your money, the wealth you've accumulated in the TSP, it's a lot more complicated than most people realize. Let's face it. The TSP assets likely represent years and possibly a lifetime worth of savings. Now is the time to protect and preserve those hard-earned assets, and that starts with making the right rollover decisions. Few retirees are aware of all these potential options. Even fewer are aware of all the key issues surrounding the options. So you're already ahead of the game. Hopefully I've helped answer some questions, but chances are you still have others. That's okay, because your participation today, it entitles you to a free consult with me. I'll tell you how that works in just a moment. Wrapping up. Okay, here's my contact information. Here's our website, my phone number. Please reach out if I can be of any help. Feel free to email me questions and share my contact information with any colleagues you have that are considering retirement, folks that might benefit from this information. Send me an email if you're interested in the free consult. My email address is here on the slide. It's a free meeting. We can answer questions from today's session. We can talk about any other issues in your financial life that might be troubling you. All of that stuff we can dive into. Meetings can be on the phone, meetings can be virtual, and meetings can be in person at our office in Frederick, Maryland, if you happen to be near our area. Your choice. I work with federal employee clients across the nation from all the different agencies. So I hope this was helpful. Thank you all so much for your time today, for being here. If we can be of any help, please let us know. Have a great day. Thanks, everyone.